So, what's grabbing headlines right now? It's the surprising pushback from major banking groups against a cybersecurity disclosure rule.
Yeah, that's right.
Now, this might just sound like, Wall Street stuff, but it really hits close to home for all of us when you think about our personal data, financial stability.
Exactly. It's a really fascinating intersection, isn't it? Regulation versus these very real cyber threats. It's not simply banks wanting less oversight.
Yeah.
It's a debate with pretty significant consequences for how we all understand and, frankly, respond to these kinds of risks.
Okay, let's get into it then. This deep dive is all about that friction between the big banking players and the SEC, the Securities and Exchange Commission, specifically over their rule about disclosing cybersecurity incidents. We're looking mainly at a news report about a letter these banking groups actually sent to the SEC. And our mission here really is to understand why they want this rule gone, what the rule actually says, and what are the potential ripple effects for the financial industry, sure, but also for you, the listener.
Okay, so let's start with the SEC side, where things stand now.
Yeah.
Back in July 2023, they finalized this cybersecurity risk management rule. And a key part of it, which is now in effect, basically says public companies have to report significant cybersecurity incidents.
Like data breaches, hacks.
Exactly. Things that have a real impact.
Yeah.
They need to report them within 4 days. 4 days of figuring out that the incident is material, as the SEC puts it.
4 days. Wow, that really does sound like a tight turnaround.
It is.
And this isn't just like sending an email, right? There's a formal process.
Oh, absolutely. The banking groups are specifically taking aim at Item 1.005 of Form 8K. That's the form U.S. public companies use to tell investors about major events. And there are similar rules for foreign companies using Form 6K. So essentially, the clock starts ticking 4 days to disclose these material cyber incidents to shareholders and the SEC using these official forms.
Got it. So the SEC's goal seems pretty clear. Get information out quickly to investors seems logical.
On the surface, yes.
So why are these big banking groups fighting it so hard? What's their main beef?
Well, their primary concern, they say, is this clash with confidential reporting.
Oh, so.
They argue that having to go public within just 4 days directly undermines their ability to share sensitive details securely, with law enforcement, other agencies.
Ah, okay.
And that confidential sharing is, well, it's critical for protecting infrastructure and warning other potential victims who might be next in line.
So the worry is going public too soon could actually make things worse, scatter the response?
Precisely. Their argument boils down to this immediate public spotlight could jeopardize ongoing investigations. It could make it harder to actually contain the attack, and ultimately it could weaken national cybersecurity efforts overall. They frame it as a trade-off: immediate transparency versus effective security.
And this is where it gets really interesting, I think. They're not just saying it's, inconvenient. They're claiming the rule was flawed from the get-go, and it's proving problematic now.
Yep, they are.
What specific problems are they pointing to?
They highlight a few key things. One is what they call the rule's complex and narrow disclosure delay mechanism.
Okay.
Basically, they're saying the rules around when you can potentially get a delay are so tricky and the process so cumbersome that it actually gets in the way of responding effectively and working properly with law enforcement. They also believe it creates market confusion.
Market confusion? How?
By blurring the lines, they say, between these new mandatory disclosures and the voluntary information they might share anyway. Think about it: if a company rushes out a half-baked disclosure just to meet that 4-day deadline.
Yeah, it could be incomplete, maybe even misleading.
Exactly. It could lead to misinterpretations, unnecessary panic, market swings.
That makes sense. Market confusion could definitely spook investors. What else is on their list of concerns?
They raise a very serious point about ransomware.
Ah, yeah.
Their argument is that publicly announcing you've been hit can be weaponized by the attackers.
How? Like turning up the pressure.
Exactly. It essentially amplifies the criminal's leverage. If everyone knows you're crippled and under the gun, the pressure to pay that ransom goes way up.
I can see that.
They also worry that disclosing too early, before they really know the extent of the damage, could hurt their insurance coverage.
Okay.
And just generally increase their legal liabilities later on. More lawsuits, bigger potential damages.
Right. Insurers might balk, lawyers might circle. Are there internal worries, too, about how this affects their own teams?
Yes, definitely. They express concern that the rule risks chilling candid internal communications. Well, If every internal chat about a potential security weakness, even a minor one, could potentially trigger this public 4-day disclosure clock.
People might clam up.
That's the fear. It might discourage open discussion among their security teams, their IT staff, hinder their ability to proactively find and fix problems before they become major incidents. It's like, why stick your neck out and flag something internally if it could instantly become this public headache?
Yeah. We'll be less open internally if we're scared every conversation goes public so fast. That feels counterproductive if the goal is better security overall.
It does seem that way.
But what about the other side? The investor's right to know. Isn't that the whole point?
And that's the core tension, isn't it? The banking groups aren't saying never disclose material cyber incidents.
Okay.
Their main point is that the existing rules, the ones in place before this specific 4-day cyber rule, already require them to disclose material information to investors.
Which can include cyber incidents if they're big enough.
Correct. If an incident is truly significant, truly material, meaning something a reasonable investor would care about when deciding to buy or sell stock, they argue the existing framework already covers it. They just want more flexibility on the timing, allowing them to disclose when they have a clearer picture and when it won't jeopardize the response.
Okay, so they're saying the old system worked, just let us use that judgment. Let's make this concrete. The report mentioned crypto companies.
Yeah, that's a really good current example.
Mm-hmm.
Think about publicly traded crypto firms like Coinbase.
Right.
They recently had that incident where support staff were bribed to leak customer data.
I remember that.
Well, after they disclosed that, Coinbase got hit with, I think the report said, at least 7 lawsuits.
Oh, okay, yeah. Disclosure has consequences.
Definitely. And add to that, Coinbase disclosed they refused to pay a $20 million ransom demand.
Oof.
And they estimated the potential damages from that whole breach could hit $400 million.
Good grief.
So you can see how, if this SEC 4-day rule were rolled back, it could give firms like Coinbase and traditional banks in similar spots potentially more time, more breathing room to assess the situation, manage the crisis, and plan their public communications more strategically next time.
More time before that mandatory public spotlight turns on. It's a really tricky balance. Who exactly is leading this charge against the rule?
It's a coordinated effort. The letter came from 5 major banking groups.
Mm-hmm.
You got the American Bankers Association, SIFMA, that's the Securities Industry and Financial Markets Association.
Okay, heavy hitters.
Yeah, and also the Bank Policy Institute, the Independent Community Bankers of America, and the Institute of International Bankers. So a broad coalition representing lots of different financial institutions.
So definitely not a fringe complaint. This is the industry establishment speaking up. And I assume their petition wasn't just like a short letter saying, we don't like this.
No. The report indicated their full petition to the SEC laid out specific, concrete examples to back up their claims. Well, reportedly, it included instances where they felt the rule created confusion for companies trying to comply. Specific ransomware cases where they believe that 4-day window actually caused harm.
Real-world examples.
And documented conflicts between this SEC rule and other regulations they have to follow. It would be great to see those specific examples actually to really understand the nuances of their argument.
Yeah, absolutely. So let's try and wrap this up. We've got these major banking groups arguing the SEC's 4-day cyber disclosure rule actually weakens security overall,
right?
Creates market confusion, maybe even helps cyber criminals. They feel the old system for disclosing material info was fine.
And on the other side, you have the SEC, whose intention was likely to boost transparency, make sure investors get timely info about significant breaches that could, affect their investment.
Exactly. And this decision, whichever way it goes, it could directly impact you, the listener. It could change how fast you hear about data breaches or cyber attacks at your bank or other companies you invest in or interact with, including in the crypto space.
It really could.
It just makes you think, doesn't it? Where is that sweet spot, that balance between the public's our right to know about security issues affecting our money and data?
Yeah.
And the potential dangers of immediate, maybe incomplete disclosure that could hamper the response or make things worse. Who really benefits most from super fast disclosure versus a more delayed strategic approach? And what does this whole debate tell us about, well, the evolving cyber threat landscape and what we expect from corporations today?
Definitely a lot to think about there and something to keep an eye on as this plays out.